Credit isn't money, but without it, money barely moves. It's the promise of power before having power. It's invisible, but its influence stretches across empires, cities, and homes. Where there is credit, there is trust. Where there is trust, there is control. And where there is control, there are those who govern and those who obey, even if neither touches a coin. In early civilizations, bartering limited action. What you owned was what you could exchange. But credit opened an invisible door. Receive now, pay later, and, with it, create dependency. Debt became language, a promise, and, above all, a tool of power. Each loan not only generated wealth, but also obligation. And with obligation comes influence. Thus began a silent story, the story of how credit turned trust into domination. For centuries, merchants, moneylenders, and bankers learned to harness this invisible power. A document, a signature, an intangible commitment could change entire destinies. Entire cities grew or collapsed depending on the faith placed in a simple piece of paper. Credit transformed markets, but it also transformed society. It made risk routine and ambition a daily driver. Each debt was an invisible rope tied around the debtor's neck, sometimes light, sometimes suffocating. With the arrival of the Renaissance, modern banking learned to institutionalize this power. Florence and Venice became temples of credit, and their bankers became masters of economic control. What began as a necessity became an instrument of political and military influence. Loans to kings and merchants, bills of exchange, interest and penalties. Every transaction was a power play. And every city, every state, every economy was, unknowingly, caught in a web of invisible debt. The 20th century brought credit to every home. Credit cards transformed debt into a daily habit, and the promise of instant consumption into a global religion. Living on credit has never been so easy, and dependence has never been so subtle. Credit became a driving force of growth, of hope, and, at the same time, of fragility. The same promise of financial freedom that seduces us also binds us to systems that almost no one understands. Today, credit is digital, fast, and global. Banks, fintechs, and invisible platforms move mountains of money that will never touch human hands. Microcredits, instant loans, risk assessing algorithms. Everything works on a thread of trust that could break in seconds. We live in a world where wealth is measured more in lines of code than in precious metals. And yet, the psychology of credit remains the same. He who lends, controls. He who owes, obeys. Credit is the most cunning invention of economic power. It doesn't require armies or physical prisons. Its strength lies in our faith. Faith in institutions, in documents, in promises. And that faith, once granted, becomes the most silent prison that ever existed. Today, we invite you to explore the history of this invisible prison, to understand its genesis, its expansion, and its masters. Each chapter that follows will reveal how credit shaped empires, determined wars, and shaped the global economy. And also how, for all its sophistication, it remains as human an instrument as the desire that created it. Because in the end, behind every loan, every line of credit, lies the same force that drives history: ambition, necessity, and trust. Credit isn't just money. It's the narrative that defines who rules and who follows. Bienvenido a Masters of Credit. Chapter 1. Barter and the First Loans. Before there was money, there was barter. Animals for grains, tools for textiles, salt for spices. Each exchange depended on the coincidence of needs, geographical proximity, and trust between individuals. It was a limited but effective system. Each person knew exactly what they owned and what they could offer. However, human life required more than occasional coincidences. Barter showed its limits as the scale of the economy grew and trade horizons expanded. How do you send grain to another village and receive tools without the exchange stopping along the way? The answer was simple and revolutionary: the loan. Give today, receive tomorrow, trust in the word, not in the immediate merchandise. Thus was born the first form of credit: intangible, flexible, and dependent on reputation. In Mesopotamia, around the 3rd millennium BC, clay tablets recorded transactions and loans. Grain delivered to a neighbor or merchant was promised interest in the next harvest. There was no bank, but there was a system of collective responsibility. The community monitored payments. If someone broke the law, the penalty was social: loss of honor, exclusion, and widespread distrust. Trust was the most valuable collateral. Without it, any credit system collapsed. This model was replicated in Egypt, where grain and oil loans ensured survival during droughts and harvest failures. Even local authorities supervised the loans, marking the beginning of institutional intervention. Credit, although rudimentary, began to shape power relations. Those who lent controlled, those who owed were tied. The balance between risk and trust was delicate, and any failure could trigger local conflicts. But humanity had taken the first step toward a much more complex financial system. In Greece and Rome, credit became more sophisticated. Merchants lent money at interest, sometimes secured by property or slaves. Written contracts, witnesses, and judges specializing in debt disputes were created. The loan ceased to be just an act of aid. It became an instrument of power and expansion. Governments also began to intervene, using debt to finance military campaigns. The pattern was clear: credit enabled economic mobility, but it also consolidated hierarchies. The risk was no longer just personal, but collective. A default could affect the entire community or city-state. And yet, faith in the word of others remained the basis of the entire system. Without trust, credit didn't exist. Without credit, trade stopped. Credit was, and still is, an extension of human psychology, the hope that promises will be kept. Early lenders understood something essential: debt could be a weapon. Providing credit not only generated income, it created dependency, loyalty, and power over debtors. In every ancient society, credit measured who could take risks and who had to obey. It was a silent tool, as effective as any army, but much less visible. Records show that loans between cities and merchants had clauses ensuring obedience and control. Sometimes debt became a political trap. If you didn't pay, you lost land, influence, and rights. Thus, credit emerged as an extension of human cooperation, but also as the first form of economic control. Each loan was a small social contract that reinforced structures of power and dependency. It was the first phantom of courage, intangible, but real in its effects. And in that primitive world, the essence of what centuries later would become the greatest invention of human control was already emerging: credit. The listener should remember, we're not talking about conspiracies or hidden secrets. We're exploring human nature and how the desire for trade and expansion led to the creation of instruments of power. Credit is neither bad nor good. It's as neutral as the word itself. Its impact depends on who wields it and who receives it. And as we progress through this audiobook, we'll see how that small initial spark grew into a global tool capable of shaping entire empires. As communities grew, so did the need to anticipate resources. Waiting for the harvest wasn't enough to receive a loan. Time became crucial, and patience began to come at a price. Loans no longer simply resolved immediate needs, but also allowed for more ambitious future plans. Building warehouses, trading with distant villages, or financing festivities. It was a rudimentary system, but with unspoken rules. Word and reputation were more valuable than any metal. If someone defaulted on a commitment, news spread quickly, limiting their chances of obtaining new loans. This mechanism of social self-control functioned as the first form of financial regulation, long before banks or complex legal contracts. As exchanges became more frequent and complex, figures appeared who acted as mediators, respected elders, local leaders, or experienced traders. They oversaw loans, guaranteed repayment, and helped resolve disputes. Without realizing it, these early societies were laying the foundations for a credit system that would endure for millennia. In Egypt, centralized authority allowed for massive credit expansion. State granaries lent grain to peasants and merchants on the condition that they returned a larger portion during the next harvest. This ensured survival, stimulated the economy, and strengthened the power of local leaders. But it also introduced an inevitable dependency. Debt generated loyalty, but it also limited the freedom of action of those who assumed it. Credit, although necessary, was beginning to be a tool of control, anticipating the dynamics that would dominate centuries later. Scribes recorded every transaction on clay tablets, and each record was a silent testament to trust and power. These tablets were as important as the gold itself, because without a record, the promise was worthless. Each debt paid strengthened faith in the system. Each default weakened it. Thus, humanity learned that words and writing could be as powerful as precious metals. Even in Greece and Rome, where trade and military expansion reached extraordinary levels, credit became a strategic instrument. Merchants lent capital to travelers in cities, ensuring a return through interest and sometimes collateral in land or property. Written contracts with specialized witnesses formalized these agreements, giving rise to a more structured financial system. Credit allowed states to finance wars, build infrastructure, and sustain expanding economies without resorting to immediate taxes. At the same time, it empowered those who controlled the flow of money: moneylenders, aristocrats, and influential merchants. The risk was no longer just personal. It could drag down entire communities if non-payment affected the chain of commerce. Each loan consolidated hierarchies, reinforced dependencies, and taught lessons about responsibility and prudence. Debt, from its origins, was a mirror of human ambition. The desire to grow and dominate, balanced with the need to trust and deliver. It was an invisible, silent, and enduring power game. Credit, then, is not simply an economic tool. It is a reflection of human psychology. It represents the faith that promises will be fulfilled, the hope for expansion, and the inherent risk of dependency. From clay tablets to modern banking systems, its essence remains the same. Give today, trust to receive tomorrow. And as we continue on this journey, we'll see how that initial spark of trust transformed into the force that drives empires, markets, and entire lives. Because even as times change, the principles of credit, trust, risk, and power continue to guide the global economy. Every loan, every debt, every transaction has roots in those early civilizations that understood that money could be more than metal. It could be power. The listener should remember, the history of credit is not just economic history. It is the history of human behavior, of power, and of dependence. This is the first lesson of this audiobook. Credit is born out of necessity, strengthened by trust, and becomes an instrument of control. And as the world evolves, that principle remains, silent but omnipresent. Chapter 2. Medieval Merchants and Moneylenders. In the Middle Ages, trade began to expand beyond local markets. Merchants traveled long and dangerous routes, carrying fabrics, spices, and precious metals, and with them they also carried the seeds of credit. It wasn't enough to have goods. Trust between buyer and seller was needed, and that trust translated into loans and deferred agreements. This is how the first loan offices were born, places where a merchant's word was transformed into a written commitment, and the debt took on tangible form. People soon understood that solvency depended not only on wealth, but also on reputation. A default could condemn a family for generations. Lenders, for their part, set strict rules, clear interest rates, defined terms, and collateral, which could include goods, land, or even personal services. The system was rigid but effective. It balanced risk and opportunity, allowing the economy to flourish without the need for a modern central bank. In cities like Florence, Venice, and Antwerp, the boldest merchants began offering credit to foreign kings, nobles, and merchants, extending the reach of money beyond local borders. This introduced a new kind of power, financial power, which could rival military or political authority, silent but decisive. As debts grew, so did the need for specialized laws and courts to ensure that commitments were honored and that sanctions were clear. Failure to comply had severe consequences: confiscation of property, exclusion from markets, or even imprisonment. These punishments were not only economic, but also social, as honor and reputation were as important a currency as any gold or silver. Social control functioned as a system parallel to the law, a network of mutual surveillance, where every merchant and citizen knew the credit history of everyone else. The most respected families not only accumulated tangible wealth, but also built credibility. This was the true capital of the medieval world. Personal and business credit were beginning to differentiate. Although both were still based on the same rule: trust must back every promise. Each successful loan reinforced faith in the system. Every fraud, however small, threatened the web of relationships that sustained the economy. Lenders learned to balance greed with prudence, because excessive interest could ruin a business and damage its reputation. Medieval credit, in essence, was a balancing act. Risk and opportunity coexisted, and power was quietly distributed among those who controlled the flow of money. And while kingdoms fought over land and titles, merchants built invisible empires, sustained only by trust and word. It was an imperfect system, but a surprisingly sophisticated one. The seeds of modern credit had been sown, and humanity was beginning to understand that wealth wasn't always measured in gold. Medieval credit was also a tool for innovation. It funded explorations, caravans, and infrastructure projects, expanding trade boundaries and connecting distant regions. Each new loan allowed the economy to advance one step faster than politics or war, proving that money could be more powerful than weapons. At the same time, this system taught hard lessons about responsibility and foresight, as one mistake could ruin not just a merchant, but an entire city. It was the first great lesson in what we would call credit power today, the silent control exerted by those who wield trust. And as we continue through this story, we'll see how these medieval practices evolved into Italian banks, European markets, and ultimately, the global credit we know today. The listener must understand, credit has never been neutral. Since its inception, it has been an instrument of growth and, simultaneously, of control. Medieval credit teaches us that the economy is not only based on tangible resources, but also on people's faith, their word, and their willingness to fulfill commitments. It's a prelude to what's to come, an increasingly sophisticated financial system where debt is as powerful as any army. In the Middle Ages, trade was no longer merely a local exchange. Routes connecting cities and kingdoms emerged, and with them, the need to rely on long-distance agreements. Merchants carried valuable goods, cloths, spices, precious metals, and along with them, seeds of debt and promises of deferred payment. Every transaction involved trust, and this trust was formalized through contracts and records written on parchment, documenting loans, interest, and terms. Loan bureaus began to appear in plazas and markets. These places were the nerve centers where wealth and reputation intersected, where a simple default could ruin entire families. The system was fragile and, at the same time, extraordinarily efficient. It allowed the medieval economy to grow without a modern central bank, relying solely on the faith of individuals and their word. In cities like Florence, Venice, and Antwerp, the boldest merchants offered credit even to kings and nobles, expanding the reach of money beyond local borders and challenging traditional political structures. Over time, this network of loans and debts generated a new kind of power, invisible but decisive: financial power, which could equal and even surpass military or political authority. Failure to make a payment had not only economic consequences, but also social ones: loss of reputation, exclusion from markets, and, in extreme cases, imprisonment or confiscation of property. These sanctions functioned as a parallel control system, ensuring that trust was maintained and that the network of credit relationships did not collapse. Medieval credit taught a clear lesson: wealth lies not only in tangible goods, but in the faith and credibility of those who possess it. As lending became more established, personal and commercial loans began to be differentiated, although both shared the same foundation: mutual trust. Each successful loan reinforced faith in the system, while each fraud threatened the economic structure and social cohesion. Lenders learned to balance risk and prudence, to calculate interest rates that ensured profits without breaking the relationship of trust with their clients. This balance allowed the medieval economy to advance even faster than politics or warfare, proving that money could be more powerful than weapons. Credit was also a driving force of innovation. It financed exploration, trade caravans, and urban projects, connecting regions and fostering prosperity. Every transaction, every written agreement, was a small act of faith that expanded civilization, building invisible empires sustained only by the human word. The system, though rudimentary, laid the foundation for modern credit, teaching lessons about responsibility, risk, and the silent influence of money. Thus, the Middle Ages witnessed not only wars and conquests, but also the birth of an invisible power that exercised through debt and trust. The listener must understand that credit has never been neutral. Since its origins, it has been an instrument of expansion and, at the same time, of social and economic control. This is the story of how humanity learned that true wealth lies not in gold or silver, but in the ability to inspire and sustain others' faith in the promised word. Chapter 3: Italian Bankers and Modern Credit. During the Renaissance, Italy became the heart of European credit. Cities like Florence, Venice, and Milan were not only known for their cathedrals and art, but also for being financial epicenters that connected the old continent with distant markets. Italian bankers, often belonging to influential families, developed a system of financial instruments that were advanced for their time: bills of exchange, loan contracts, and commercial insurance. These tools allowed money to be transferred over long distances without the need to transport precious metals, minimizing risks and streamlining international trade. States and monarchies soon discovered they could finance wars and infrastructure projects without relying solely on taxes, turning to bankers for significant loans. modern credit began to be institutionalized. Accurate accounting records, interest rate rules, and debt recovery protocols were established, creating the basis for a reliable system. The flow of money through these families and banking houses not only generated wealth, but also political influence, making bankers key players in state and diplomatic decisions. Every loan to a prince or city-state was backed by trust, but also by strategy. Bankers knew when to demand repayment, when to renegotiate, and when to take risks to expand their economic power. Credit allowed Italy to finance trade expeditions, develop industries, and maintain a network of relationships that extended its influence beyond its borders, without the need for armies. Thus, money ceased to be just metal or paper. It became a promise and a contract, in a system where word and faith carried as much weight as gold itself. The 15th and 16th centuries witnessed not only the rise of art and culture, but also the birth of an invisible power: finance. Italian bankers showed that credit could overcome military force, and that cities that mastered it controlled routes, markets, and political decisions. Bills of exchange and state loans were the first steps in what centuries later would become central banks and global financial markets. Each transaction reflected a delicate balance between risk and trust, a silent game of influence that consolidated economic empires without spilling a drop of blood. Modern credit was born out of necessity, but also out of ingenuity. It was a tool to expand trade, secure profits, and project power beyond the tangible. The listener must understand that this system not only facilitated wealth, but also taught that whoever controls credit also controls the society that depends on it. The deferred promise of payment, the bill of exchange, and written contracts were the new, invisible but decisive instruments of authority that shaped Renaissance Europe. During this time, the eternal lesson was solidified. Trust can be more powerful than any army, and credit more deadly than the sword when used as a tool of control. Thus was born a legacy that remains relevant today. Money doesn't just buy goods. It buys influence, decisiveness, and the ability to shape history without being seen. During the Renaissance, Italy became the financial heart of Europe, a space where commerce and culture coexisted and mutually enhanced each other. Cities like Florence, Venice, and Milan weren't just centers of art and architecture. They were epicenters where money began to acquire an almost mystical power, capable of moving armies, financing wars, and sustaining empires without a single drop of blood being spilled. Italian bankers, often belonging to influential families like the Medici, developed financial instruments that were advanced for their time. Bills of exchange, loan contracts, commercial insurance, and ledger accounts that allowed precise control of monetary flow. These tools not only facilitated international trade, but also reduced dependence on precious metals, allowing money to be transferred over long distances without the risk of transportation or theft, building a network of trust that spanned seas and mountains. Credit, then, ceased to be just an exchange of goods. It became a promise of power. States and monarchies discovered they could finance military campaigns and infrastructure projects without relying solely on taxes, turning to bankers for loans that shifted the balance of power in Europe. The birth of modern credit was cemented by precise accounting records, interest rate protocols, and debt recovery rules. Every transaction was carefully documented, and faith in the written word was as vital as gold itself. Banking families didn't just accumulate wealth, they accumulated influence. They could decide who received loans, which cities were financed, and even which wars were fought. Economics and politics began to become inextricably intertwined, and invisible money became a tool of control. Each bill of exchange was a promise to pay, but also an instrument of power. Bankers knew when to demand payments, when to grant moratoriums, and when to use debt as leverage to influence political decisions, establishing a silent but relentless system of dependency. Florence and Venice, in particular, benefited greatly from this innovation. Their merchants could embark on trading expeditions without risking large amounts of gold, while bills of exchange ensured that funds reached their destinations, creating a steady flow of wealth that sustained urban and artistic expansion. The system also had profound social consequences. Trust became a parallel currency. A reliable merchant could prosper, while suspicion of non-payment could ruin entire families. Faith in credit, rather than military strength, began to determine who rose and who fell in the social hierarchy. The 15th and 16th centuries taught a lesson that still holds true. Money doesn't just buy goods, it buys loyalties, influence, and the ability to shape history without visible weapons. Bills of exchange, contracts, and accounting records were the first links in modern financial markets, and Italian bankers were their invisible architects, designing a system where wealth could grow faster than gold itself. Every loan to a state, every bill of exchange to a foreign merchant was part of a delicate balance of risk and trust. Bankers learned to manipulate this balance, using credit not just to make money, but to consolidate power, influence, and control over entire nations. Modern credit, born in the streets and palaces of Italy, was not neutral. Every transaction reflected power strategies, conflict anticipation, and the ability to project influence beyond borders. Bankers understood something fundamental early on. Money without tangible backing isn't weak if faith in it is strong. And so, what began as a tool to facilitate trade became an invisible weapon of control and domination. This lesson resonates today. Whoever controls credit controls the economy, and whoever controls the economy has the power to influence societies, governments, and historical destinies without having to occupy territories or deploy armies. The legacy of the Italian bankers remains. Trust in the promise of payment remains the foundation of the entire modern financial system. Money ceased to be metal. It became faith, contract, and strategy. The skill in wielding this faith defined empires, consolidated families, and taught that true power isn't always visible, but it can always be felt. Chapter 4: Credit Cards and the Massive Expansion of Consumption. The 20th century introduced a quiet but profound transformation in the global economy. Credit ceased to be the privilege of merchants or states and became accessible to anyone with access to a bank or a credit card. What was once a personal agreement based on trust and reputation has become an impersonal, codified, standardized instrument available to millions. Suddenly, money wasn't just what you had in your pocket or in a tangible bank account. It was also the promise to pay tomorrow, the extension of your spending power beyond your current resources. Credit cards transformed habits, desires, and expectations. Purchases ceased to depend on the accumulation of wealth and became dependent on the trust issuers placed in each cardholder. Consumption became a social language. Having a card was a sign of modernity, of access to goods, of participation in a world where money flowed faster than tangible production. But with the expansion of credit also came the illusion of wealth. Houses, cars, clothes, trips. Everything could be acquired without the buyer having to first generate the necessary capital. The system encouraged debt accumulation as a driver of growth. Interest rates, minimum payments, and promotions created a cycle in which the illusion of prosperity mingled with the reality of mounting obligations. Massive debt began to show its face. Financial crises, personal bankruptcies, and social pressure on those who couldn't sustain the pace of consumption that credit offered. However, credit also created opportunities. It allowed families to access education, housing, and social mobility that would have previously been unattainable. Thus, credit cards became a double-edged sword. Freedom and deception, progress and debt, illusion and reality, demonstrating that the power of modern money lies as much in its ability to create wealth as in its ability to generate dependency. Every purchase, Every line of credit, every deferred payment represented a silent contract between the individual and the financial system. A contract that dictated habits, shaped behaviors, and consolidated a mass consumption ecosystem sustained by faith in an economic future that always promised more than it delivered. Banks and issuers quickly understood that it wasn't just about lending money. It was about building a framework of trust that allowed millions of people to live in a constant flow of credit, perpetuating a cycle that combined apparent freedom with financial control. The first half of the 20th century ended with a clear lesson. The democratization of credit could boost entire economies, but it also generated massive systemic risks. By the end of the century, markets were already showing that massive credit could sustain the illusion of wealth to unsustainable limits, paving the way for future financial crises that would be as global as they were unexpected. The power of plastic lay not in the material itself, but in the faith society placed in its promise. Pay later, access now, living in a world where money was virtually infinite for those who knew how to manage it. With each transaction, an invisible web of dependency was woven, where consumers trusted a system that could expand their spending capacity beyond their means, and banks quietly but relentlessly expanded their economic and social influence. Massive lending proved that wealth doesn't always need to exist physically to generate power. All it takes is a promise, faith, and proper risk structuring. The credit card then became a symbol of modernity, freedom under conditions, prosperity subject to invisible rules, and dependence hidden under the guise of financial autonomy. The 20th century taught us that credit could be the key to opening seemingly closed doors, but it could also be the chain that trapped entire generations in a cycle where spending and debt were inseparable. Chapter 5: Credit as an Engine of Wars and Businesses. Since the dawn of history, credit has been much more than an economic tool. It has been an engine of power, an instrument capable of determining the fate of nations and corporations. When states needed to finance wars, simply accumulating gold or taxing it wasn't enough. It was necessary to extend promises of payment, commitments that materialized in debt, in bonds, in letters that linked the present with an uncertain future. Credit allowed rulers to mobilize larger armies, purchase weapons, and sustain campaigns that would have been impossible otherwise. Quietly, faith in future repayment became an extension of political power, where the ability to borrow was equivalent to the ability to dominate. And while armies marched, corporations also found in credit the opportunity to expand, innovate, and position themselves globally. Companies that would have remained local or limited by capital were transformed into international players thanks to access to massive financing. Credit allowed ambition to overcome the constraints of the present, creating economic empires that coexisted with political and military empires. However, this expansion came at a price. The interdependence between debt and power created vulnerabilities. A default, a bankruptcy, or a non-payment could reshape not only a country's economy, but also its position on the global stage. In World War I, for example, war bonds became an essential tool. Citizens from all walks of life financed the war effort with the promise of future returns. Each loan represented not only money, but also legitimacy, trust, and an invisible contract between the individual and the state. The system worked because society believed that debt could sustain the ambition of rulers and that faith in the written word was as powerful as any army. During World War II, credit once again demonstrated its power. The United States financed the Allied effort with a combination of taxes and debt, generating a multiplier effect on the economy and industry. Corporations producing weapons, transportation, and food grew at unprecedented rates, supported by lines of credit that backed both the war effort and industrial infrastructure. The world learned that debt could be both a catalyst and a risk, that borrowed money could build empires, but also bring them down if trust was broken. In peacetime, the same principle applied to large corporations. Mergers, acquisitions, and massive expansions were only possible through the strategic use of credit. Banks and lenders, invisible but powerful, became the arbiters of corporate success and failure, defining entire markets without firing a single cannon. Every contract, every line of credit, every risk assumed established power relations that transcended financial statements. They shaped politics, economics, and society in a cycle that repeated itself generation after generation. Credit, therefore, ceased to be just borrowed money. It became the invisible fabric that united ambition, risk, and control, demonstrating that those who dominate the flow of credit silently control the destiny of entire peoples. Modern history is full of examples, from Napoleon financing armies with bonds to multinational corporations expanding their reach through strategic debt. In each case, credit served as a lever of power. Beyond coins and bills, true value lay in trust and the ability to project obligations into the future. The risk was always present, and with it, the opportunity. A poorly calculated loan could mean the collapse of an empire. A well-managed loan, the consolidation of economic and political hegemony. Thus, credit became an engine that moved armies, corporations, and economies, demonstrating that true strength lies not always in what one has, but in what one promises to have. Even today, in the digital age, credit retains its power. Microcredit, fintech, and instant financing systems replicate the same historical principle. Borrowed money remains a tool of ambition, an extension of human faith, and a reminder that control over debt equals control over the actions of millions. Therefore, studying credit is not just about understanding economics. It's about understanding history, politics, warfare, and society, and how humanity has built entire systems on the promise of future payment. Every loan contains within itself the paradox of power, apparent freedom for the debtor, invisible dominance for the lender, and a silent bond that conditions the present and determines the future. Credit, then, is the most effective invention of control that has ever existed, because it teaches us that obedience doesn't always require force. It's enough to believe the promise. Chapter 6: Microcredit, Fintech, and Digital Credit. The arrival of the digital age radically transformed the way we think about credit. What once required physical contracts, notaries, and local banks is now done in seconds through apps and online platforms. Microcredits allow small businesses anywhere in the world to access instant financing without traditional intermediaries. The same is true of digital payments, which eliminate cash and turn every transaction into an invisible but perpetual record on centralized servers. This change represents a huge opportunity: financial inclusion for millions who were previously outside the banking system. But it also brings a hidden risk: the total dependence on technological systems and the trust in algorithms that decide who gets credit and who doesn't. Fintechs, digital banks, and instant loan platforms exert invisible control, shaping behaviors and economic decisions almost imperceptibly. Every line of credit approved, every deferred payment, every algorithm that predicts risk is part of a new power structure that doesn't require banknotes or precious metals. Digital credit expands human ambition because it allows debt and consumption to be projected beyond what the tangible economy could sustain. And while we marvel at the ease and speed, few realize that this system depends entirely on technological stability and collective faith in digital record-keeping. Microcredit platforms, initially designed to help entrepreneurs and low-income individuals, have demonstrated how credit can be democratized and monitored at the same time. Every transaction, every small loan, generates data that allows for real-time risk assessment, automatically adjusting rates and terms. But this immediate access also transforms the relationship between debt and responsibility. The ease of obtaining credit can lead to silent over-indebtedness. Digital credit creates a vicious cycle. The more it's used, the more dependent we become on systems that no one physically touches, yet which simultaneously sustain and limit us. At the corporate level, fintech companies and digital banks are accumulating unprecedented power, algorithmically deciding who thrives and who is excluded. The decentralization of blockchain and cryptocurrencies promises autonomy, but also creates volatility, demonstrating that even in systems without intermediaries, risk remains. Every digital transaction leaves a trail that, although invisible to the human eye, constitutes a record of power and control, a testament to the reach of credit in everyday life. Digital credit expands the horizon of human ambition, but it also redefines the notion of freedom. Are we masters of our money, or mere users of systems that dictate our possibilities? In this new paradigm, financial education and credit awareness become essential. Without them, inclusion can turn into dependency. Finally, the era of digital credit proves that debt doesn't require paper, metal, or visible contracts. All it takes is algorithms, servers, and collective faith in a system that only exists in the cloud. The risks are clear. A massive technological failure, a hack, or the collapse of key platforms could trigger a global domino effect, where digital money becomes momentarily invisible. Still, the opportunities are enormous. Financial inclusion, expanding entrepreneurship, social mobility, and the possibility of a more dynamic and accessible economy. The key is balance, using digital credit as a growth tool, but without losing sight of the fact that true security still lies in the ability to understand and control our debt. Microcredit, fintech, and digital credit aren't just transforming the economy. They're redefining the relationship between power, trust, and control, teaching us that debt remains a form of influence, albeit an invisible one. Every automatically approved loan, every risk algorithm executed, is a reminder that credit is the quietest, yet most powerful tool of social and economic organization. Ultimately, this digital revolution confronts us with an age-old question. Are we free if our access to money depends on systems we can't touch? Digital credit is the final frontier of control, combining speed, reach, and technological dependence in an unprecedented way. The average user lives relying on an intangible system, whose gears they never see, and whose failure could transform their reality in a matter of seconds. Thus, the history of credit repeats itself, a tool that begins as a means of inclusion and growth, and which, without awareness, can become an instrument of absolute control. The difference now is that the prison is virtual, invisible, and silent, but just as effective. We live surrounded by money we never touch, yet it defines us, conditions us, and governs us. Final reflection. The art of lending and controlling credit has accompanied humanity since its earliest exchanges, evolving into a silent force that shapes entire societies. Every loan approved, every line of credit granted, reflects a power relationship that is rarely seen, but always felt. The listener, following this story, becomes a witness to a system that promises growth, inclusion, and freedom, while weaving an invisible web of dependency. From the first bills of exchange in Florence to microcredit and digital platforms, the pattern remains the same. Trust, debt, and control. Credit has allowed empires to expand, wars to be financed, and businesses to grow faster than the tangible economy that supports them. At the same time, this same tool has created vulnerabilities, financial crises, and technological dependence, reminding us that the most subtle power is also the most enduring. Every credit card, every digital lending app, every algorithm that decides whether to approve or reject a loan is a cog in a mechanism that governs the economic lives of millions. The listener should not seek certainties, but rather understand that credit is more than money. It is the modern form of power, invisible but penetrating, capable of sustaining and conditioning at the same time. The contemporary challenge is to learn to navigate this system with awareness, to take advantage of the opportunities offered by credit without succumbing to its silent control, without forgetting that every debt is also a bond. Finally, let us remember that credit is not simply a financial tool. It is the most ingenious invention of human power, because it promises freedom while holding back invisible chains.